Before you even think about putting a single dirham into Dubai real estate, there is something you need to hear. Because I've seen and watched buyers, smart, well-intentioned people, lose not just their money, but months of their lives fixing mistakes that were entirely avoidable. It wasn't the property, it wasn't the market. It was what they didn't know to avoid. And that's exactly what I'm giving you today. In this video, I'm walking you through the most common and the most expensive mistakes buyers make in Dubai. Mistakes I've seen up close. Mistakes I've helped clients recover from. And mistakes you can sidestep right now with the right insight. So if you're serious about protecting your capital, and if you want to buy smart, not sorry, stay with me until the end, because this one video could save you just a lot more than just money. Hi, I'm Bryce D'Souza, Senior Property Consultant at Experience Realty, a Dubai-based real estate consultant with a difference. I work with buyers from every corner of the world. Some relocating, some simply chasing a lifestyle dream. Dubai is a market of incredible potential, but it's also emotional, distracting, and at times, unregulated. This video isn't about hype, it's about protecting you. So let's cut through the noise and let's get clear on what smart buying really means. Buying based on hype, not fundamental. It's easy to get swept up in the buzz, the flashy Instagram ads, the glossy brochures, the last words, last unit remaining. They are designed to trigger urgency and the fear of missing out. But let me say this clearly. Real investors don't follow hype. They follow fundamentals, because hype fades. Fundamentals last. So before you buy, ask questions that brochures won't answer. What's the price per square foot compared to nearby ready units? What's the long-term vision for the location? Is this launch priced above resale comparables already? If so, you're buying into the peak, not a deal. Let me share a quick story. One of my clients jumped into a lakeview studio. It sounded perfect, but the lake faced 5 years away. Today he's stuck with a sand-facing unit, sky-high fees, and zero end-user demand. That's not a bad market. That's simply a bad buy based on assumptions, not facts. So here's your tip. Before you trust any claim, validate it against real resale data, not launch hype, not colorful slides, not developers' promises. Because fear of missing out fades fast, but your money, that needs to stay smart, protected, and growing. Blind trust in a developer. A big name, a sleek brochure, a stunning 3D render. It's easy to assume that a well-known developer equals guaranteed quality. But here's the reality. Some developers are brilliant at designing dreams, but terrible at delivering them. I've seen it firsthand. A client of mine paid 2,000 dirhams per square foot of what was marketed as a luxury tower. At handover, low-grade tiles, cheaply finished lobby, and a rental demand that came in at 25% lower than the projected one. It wasn't bad luck, it was just poor due diligence. So here's your non-negotiable checklist before you trust any name. Visit one of the completed projects. Walk it. Touch it. Feel the quality. Ask questions. Was the handover on time? Any quality complaints from owners or tenants? Check DLT and real records. What's the track record? Any delayed or cancelled projects? Confirm if they have an escrow account. No escrow? Walk away. And here's the golden rule. Never fall in love with the render. Fall in love with the reality. Because marketing is meant to impress you, but only the finished product will live with you. So validate the vision before you invest your money, your time, and your peace of mind. Payment plan illusions. Imagine this. You're being offered a dream. Move in today, pay tomorrow. It sounds easy. It feels like flexibility. And your mind instantly says, this must be smart. Pause for a moment and ask yourself, who's carrying the weight here? Because it's not the developer. It's not the bank either. It's you. Now let's reframe that. You're not just buying property. You're buying the lender. You're financing the deal without the power, without the protection, and without the full picture. And what they don't say out loud is already costing you. Those post-handover payment plans, they're not free. They're not kind either. They come preloaded with interests, disguised as inflated pricing. So here's what they're selling: ease. You're absorbing the pressure, and that pressure, it compounds. Let's future pace this. What happens when interest rates shift? Your cash flow plans changes. Your investment risk grows. And the thing that felt affordable now eats into your peace of mind. Because here's the truth most people avoid. Affordability without fundamentals is just delayed depreciation. Let that sink in. Now ask yourself, is this a deal I'm in control of? Or a setup dressed like opportunity? Because smart investors don't just chase what's easy. They pause, they compare, they ask the right questions. They say, let me look at the resale value. Let me test the rental demand. Let me measure the exit before I enter. That's how they stay in control. So as you listen to all those flashy payment plans, take a breath. Step back. Choose to see the beyond the marketing. Because the real winners, they don't react. They respond with strategy. No exit strategy. Buying is emotional. Selling is transactional. Most buyers forget that. Here's your checklist. Can you rent this unit under 30 days? Are the buyers waiting for you to exit early? Is there mortgage eligibility for second-hand buyers? For example, a client bought a high-floor apartment in a tower with no community, zero retail, no families. A year later, the resale offers were 12%, 12% lower than purchase price. When you look at a property, don't just ask, can I buy it? That question is rooted in the now. Instead, ask the questions smart investors always ask. Can I sell it tomorrow without stress, without loss, without waiting? Because liquidity is power. And if you're considering off-plan, here's a simple truth. Hold it for at least 3 years. Why? Because that's where the capital appreciation really lies. And that's where momentum builds. Demand rises and your profit potential expands. So before you jump in, look ahead. Ask better. Invest wiser. That's how you play this game to win. Ignoring floor plans and hidden fees. You walk into a show apartment. High ceilings, elegant pool, marble everywhere. It feels luxurious. But here's a question nobody's asking. Does the layout actually works for you? Or just looks good in pictures? Because luxury isn't about what hits your eye. It's about how it lives. I've seen it too often, the illusion of space without actual function. Here's what you need to watch for. The tiny bedrooms that barely fits a bed, or windowless dens labeled as third bedrooms. Oversized balconies that inflate the square footage but add no real value to where you live. Now let's talk service charges, because they don't end after you buy. In luxury or branded residences, expect to pay around 25 to 40 dirhams per square foot. That's for the marble, the lobby, the concierge, the gym, the experience. And in mid-market projects, you're looking at 15 dirhams to 25 dirhams per square foot. More practical, but less significant. The price tag may catch your eye, but it's the ongoing costs that stays with you. So before you fall in love with the view or the brand, ask, what do the service charges actually cover? Do they match the lifestyle you're expecting, or just the brochure you were just handed? And don't forget the sneaky ones, the central cooling charges often get tucked inside your Deva bill. Miss that, you miss the real cost. Here's a real world example. A buyer thought he landed a 3-bedroom in JVC. In reality, 2 proper rooms and a windowless cubicle. All that with 30 dirhams per square foot service charge, dragging down his rental yield. A tip: don't look at total areas, look at the usable space. And always calculate net yield after charges, not before. Because luxury isn't just about how it looks, it's about how it performs financially, functionally, and long term. The advisor works for the developer. Not every consultant is who they claim to be. In fact, many are just salespeople tied to a single developer. So how do you know who's really advising you and who's not just closing a deal? Here's your mental checklist. Are they showing you options across at least 2 to 3 developers? Or is it always just one name, one brochure, one push? Do they talk about risks or only rewards? Because real advice isn't one-sided. Are they rushing you? Urgency without logic is pressure, not guidance. Here's the truth. A real property consultant will show you what not to buy. They'll point out the red flags, others skip, and they'll help you walk away when the deal doesn't serve you. That's just how you know they're real. That's who you want on your side. Assuming short-term rentals equals easy passive income. On paper, short-term rentals sounds amazing, right? High nightly rates, flexible use, passive incomes. You probably imagine the bookings rolling in while you sip your coffee and check your calendar. But here's the part most people don't hear. Until they have already bought the property. Let's get real for a second. Short-term rentals licenses aren't optional. They're mandatory. No license, you're not legally in business. Competition is fierce. You're not just listing a unit. You're entering a crowded arena of hosts with professional photos, dynamic pricing, and 200 plus 5-star reviews. High turnover sounds profitable until the maintenance begins. Think cleaning, repairs, guest issues every week, sometimes every day. It adds up. Time, money, stress. So here's the truth that seasoned investors already live by. Don't count on the short-term rental income unless you got 3 things locked in. A licensed operator who knows what they're doing, a pricing strategy that adapts to demand, seasonality, and competition. Your short-term rental license already approved and in hand. Because wishing for cash flow, it's not a strategy. Planning for it is. And that's how you turn a good idea into a smart investment. Not understanding ownership structure. You found a property, it looks great. The numbers check out. The location feels right. But before you rush to sign, ask yourself something most buyers never do. Is this really fully freehold? or are there hidden terms under the surface? See, Dubai isn't one size fits all. There are freehold zones, then there are leasehold zones, and sometimes it gets even more trickier. In certain towers, some units come with usage clauses, some with restrictions, and some with escalations buried deep into the lease. So here's your checklist. Is it freehold under DLD or a leasehold disguised as one? Number 2, are there escalation clauses or service charges that increases over time? And number 3, are there ownerships restrictions by nationality, visa, status, or company structure? Let me give you an example. A client bought an apartment in the IFC thinking it was a straightforward leasehold deal. But hidden in the fine print was an escalation clause on ground rent. On paper, they expected a 7% yield. In reality, it dropped to 4.2 overnight. And here's your power move. Before you sign, pause. Ask, have I really looked at the lease? Not just skimmed through it, but simply truly understood it. Because that lease is not just a formality, it's a rule book. That boundaries and the financial heartbeat of the investment you are stepping into. It defines how long you own the right to stay, what you'll pay in ground rent and service charges, and exactly what you can and can't do with your property. Renovations, subletting, even pets, it's all there. And here's the part most overlook. If the seller hasn't cleared the past dues, you inherit the problem. That includes unpaid charges, violations, or pending fines. The moment you sign it, it becomes yours. So if you're serious about protecting your capital, always, always, have a legal expert review your paperwork. Don't assume, don't skip, don't rush. Because once that ink dries, those terms becomes your reality. And if you're a kind of investor who plans short-term, plays smart, and wants control, this is one step you never want to miss. Skipping legal advisor's review. Adding to the above, because Dubai's process is fast and digital, many buyers skip legal reviews. That's dangerous. So here's my tip to you. You need an expert to spot risks, not just a broker to celebrate your booking. And lastly, this would be a bonus, believing in the guaranteed ROI pitch. You've heard it right. Guaranteed 15% ROI, no risk, no stress. Just sign here. But let's pause for a moment. Ask yourself, if it's really risk-free, where's the guarantee in writing? Here's the uncomfortable truth. There's no such thing as risk-free 15% return, especially in real estate. Returns this high always come with variables. Market shifts, occupancy rates, developers' performance. Yet, many fall for it. Why? Because it's dressed up with urgency, polished with brochures, and big promises. So let's shift the question. Next time someone says guaranteed, don't just smile and nod. Ask, who guarantees this? Is it a government entity or a bank? A third-party insurer? And then ask to see it in writing. Because if it's not documented, it's not real. Simple. Remember this. Smart investors don't chase hype. They check the paperwork. If it sounds too good to be true, it usually is. So protect your capital. Question boldly and invest with eyes wide open. These mistakes are avoidable. I've seen people lose 6 figures. But I've also seen smart clients gain returns most cities can't even touch. You just need the right questions and someone who isn't just trying to sell you something today. So if you're planning to buy or want to explore your options, Let's connect on a number mentioned below. My name is Bryce D'Souza. Let's connect before you commit. No pressure, no pitch, just real answers.